Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. Last week, we had three of the world's most powerful central banks, the Fed, the ECB, and the BOE, raise rates to a new 14-year highs, a signal that they are likely to hike at least once more and remain restrictive for a while. This week, the various central bank officials follow up tightly with the same messaging in their respective public speeches, with some particularly flagging out the blowout US job data, and the strong ISM service PMI released last Friday. Markets did not react very positively to it, especially equities, which fell across the board. To discuss our thoughts on these macro events, I've invited Fook Hien, our senior investment strategist, to join us today. Hi Fook Hien, let's address the elephant in the room. How do we gel the blowout US job data and the somewhat hawkish Fed speak this week? And most importantly, how can investors react to it?
Yeah, thanks very much, Zhong. So, yes, apart from the blowout US jobs data, we also saw the services sector business confidence indicators, or PMI, were also strong. And this triggered a market repricing of rates and a rebound in the bond yields. Now, this strong data explains why the Fed Chair Powell and other policymakers, they have highlighted the need for continuing with monetary tightening and holding policy rates restrictive for a long period of time. The New York Fed President Williams actually said this week he expects to keep rates restrictive for a few years to bring inflation back to 2%. Now, similarly, in Europe, the ECB officials warned that they are a long way off from pausing in rate hikes, given a more challenging inflation backdrop than the US. So while central banks remain hawkish due to inflation concerns, and we saw a strong US jobs data, some other leading indicators in the US, especially in manufacturing and housing sectors, are deteriorating. Now, this include your declines in the job quits to layoff ratio, which indicates less confidence of employees on the outlook for jobs. And in the manufacturing sector, we see inventory growing faster than new orders. So order backlogs are shrinking, building permits are contracting, and then the US government bond yield curve is still inverted. There's also a rise in auto loan defaults and contraction in money supply. So for investment implications, we think the higher rates but slowing growth would be a headwind for risk assets. So we think investors should lock in gains from the rally in US and Euro area equities. Now, if we look at the US, the S&P 500 index, it has broken below the 4,100 technical support level. This raises the risk of further declines towards the next support around 4015, followed by 3886. And in Europe, if we look at the Eurostoxx 50 index, it is approaching key resistance levels around 4288 and 4396. So equity investors, we think they may consider rotating into Hong Kong and China equities. These are our preferred region, particularly if the Hang Seng Index reaches your key support levels at 20,300 and 19,300. Now, more broadly, we would gradually rebalance from equities to a broader income basket. And the broader income basket now offers better yields after the recent rebound we saw in the US government bond yields. And within the bond space, we continue to think that the Asia US dollar bonds remain attractive. It is our preferred area in bonds as we see the spreads continuing to tighten with China's improving growth outlook.
So, Fuken, you spoke about the higher government bond yields after the recent bounce. Surely that will affect the US dollar. Do you think the greenback could rise further after this week bounce?
Yeah, you're right. The greenback US dollar has bounced. Then we expect the recent bounce to be short lived, actually. We expect it would consolidate in the next few weeks before resuming its downtrend. So while we expect the US Fed to raise rates by another 25 basis points This is less than what the market is pricing for rate hikes in the Europe, Australia, and New Zealand. Therefore, we expect your interest rate differentials to move against the US dollar in the coming months. And also, China's reopening and a more optimism on global growth, this could remove the marginal safe haven demand for US dollars. So, from a technical perspective, for the DXY index, we see the 50-day moving average at 103.5 as a resistance level, followed by 104.7. Meanwhile, we see technical support levels at 102, followed by 100.8.
Another asset that bounced this week is the Indian equity, and Adani Group appears to be at the center of it. Do you expect the issues related to the Adani Group to really impact the broader Indian equities?
Yeah, so one of India's largest conglomerates, the Adani Group, as you said, they've come under pressure after allegations of corporate governance issues. So within the conglomerate of Adani, combined market capitalization of bonds and shares is down over 100 billion US dollars since the publication of a report by a US activist short seller. If you look at the broader Indian equity markets, though, they have been resilient. It fell initially but recovered, and the benchmark Nifty index is down just under 2% this year. So, in our view, the risk of a contagion is limited. This is given the negligible exposure of Indian banks and domestic institutions to the group. We think that India's macro fundamentals remain strong, and the recent group budget was pro-growth. It maintains fiscal prudence, but it's also likely to keep inflation expectations muted and support India's growth recovery, which is still superior to its peers. Now, in addition, the domestic interest rates are expected to peak, with the consensus seeing the RBI rate hike this week as the final one in this tightening cycle. Corporate performance also remains robust, with earnings delivery the strongest since 2004. And consensus expects the Nifty index to deliver 13% and 15% EPS growth in the financial years of 2023 and 2024. And this would make it 4 consecutive years of double-digit EPS growth. Now, in addition, we see a light investor positioning in India equities after about 20 billion US dollars of outflows over the last 12 months. But your domestic equity flows are resilient, supported by strong monthly inflows into your stable, systematic investment plans. And this is a key support for the equity market. But given the elevated valuations for Indian equities, we expect India equities to perform in line with Asia ex-Japan equities.
Let's change track a little and maybe talk about the global semiconductor industry. It seems like these high-tech firms are caught in the crossfire between US and China. Any thoughts on that?
Yeah, we've seen recently as well rising US China geopolitical tensions. And there are reports of the US government considering a ban of direct investment in a certain high tech sectors in China. And other countries also joining the US to restrict the sales of advanced equipment to China. Now, we think these moves should come as no surprise with the increasing rivalry that we see in a multipolar world. And for US semiconductor companies, though, China comprises a significant 31% of sales. Now, it's unlikely all 31% of this is deemed high tech, but still, any restriction on sales would have a negative impact on the US companies selling to China. This negative impact could be mitigated if the companies can divert the sales to other parts of the world. And indeed, we think that your non-China Asian companies, they could benefit if they can make the necessary semiconductor investments and sell end products to China and enlarge their market share. And with decreased competition, they can then generate higher returns, which is attractive. Now, aside from the geopolitics, the chip prices, such as memory chips, they remain on a downtrend in Q4 of last year. And this is expected to continue until a trough, potentially in Q2 or Q3 of this year. The structural demand for semiconductor chips is robust. We see AI, artificial intelligence, grabbing more attention now. And this is in addition to your digitalization and electrification trends. However, on the other side, we will not underplay the impact from a potential US recession. This could hit demand cyclically. So overall, we have a neutral view of the US technology sector, including the semiconductor stocks over the next 6 to 12 months.
Thanks, Fook Hien, for the very insightful discussion. I guess the key takeaways today for this week are that the central banks are likely to trudge on, the dollar likely to consolidate in the next few weeks before resuming the downtrend, and we see a low risk of a contagion from the Adani Group issues. And your tech sector, including your semiconductor stocks, they are likely to perform in line with the markets. And with that, we'll close the podcast for this week. Thank you so much for joining us today. Enjoy the weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.